Good day, everyone. Welcome back. In this video, I'm going to be giving you three simple concepts that are clear and objective that will help you tell what the next daily bias is most likely to be. So the first is the next day model. I learned this from T2 Trades. Shout out to him. You can check out his videos. They're actually very informative and easy to understand. Then the next concept is swing points, and the last is liquidity delivery. So let's talk about each of these concepts. All right, the next day model has to do with the previous daily high and the previous daily low. Now, the previous daily high and previous daily low are strong draws on liquidity, and they are very easy to identify. When you open your chart, you want to draw the previous daily high and the previous daily low. Price is most likely to reach out for one of this level of liquidity. Now, in order to tell which of this liquidity is price most likely to run for, that is, will price run for the previous daily high or run for the previous daily low? In order to do that, we have to understand these three concepts. The first is the continuation pattern, second is reversal pattern, and then the third is consolidation pattern. Okay, so when you go to your chart and you pull out the previous daily high and previous daily low, if price takes the previous daily high and closes above it, you want to expect that the next day that will be printed will be a bullish day to run forward the previous daily high, like we see here. Then the reverse is the same for a bearish market. If price takes the previous daily low and closes below it, then you want to anticipate that the next day is going to run for the previous daily low, like we see here. All right. So that's for the continuation pattern. Then for the reversal pattern, when you mark out your previous daily high and previous daily low, if price takes the previous daily high and then retrace back into the range, that is, it fails to close outside the previous daily high, then you want to identify that day's previous daily low, anticipating that the next day will run for the previous daily low, like you can see here. All right. Then the reverse is the same for a bullish market. If price runs for the previous daily low and then retraces into the range, that is, fails to close outside this previous daily low, you want to mark out the previous daily high and anticipate that the next day will run for the liquidity above the previous daily high. I hope that's clear. Then for a consolidation market, this is when the candle printed neither takes the previous daily high nor the previous daily low. At this moment, you want to wait for price to take either of the previous daily high or the previous daily low before anticipating where price is most likely to go. All right. So you can see here, this candle being printed did not take the previous daily high. Neither did it take the previous daily low. So you want to sit on your hands and wait. And as this previous daily high was taken, I want to anticipate that the next draw on liquidity will be this previous daily high. And then the reverse is the same for a bearish market. If price creates a candle which did not take the previous daily high or previous daily low, you want to wait because here market is consolidating. Now, once you see the previous daily low taken, you want to anticipate that the next candle that will be formed will take the previous daily low. Now, another way you can also tell where price is most likely to go is if the candle inside the range is a bullish candle. All right. It tells you that most likely the next candle that will be printed will be a bullish candle. The same, if the candle inside the range is a bearish candle, it's a telltale sign that the next candle that will be printed will be a bearish candle, even if the previous daily low or high was not taken. I hope that's clear. So let's go to the chart so we can look through some examples. So here's the Euro USD. This previous daily high was taken. So what do? We're anticipating that the next day price is going to run for the previous daily high. So we're expecting a bullish day. Good. Now you can see price ran for the previous daily high and then closed above it. So now we're anticipating that the next drawn liquidity will be the previous daily high. All right. Now we can see that price took out this previous daily high, but retraced back into the range. Now, when we see this, we want to look out for what the previous daily low to be the draw on liquidity. Okay, and you can see how price ran for the previous daily low. Now, this candle closed below the previous daily low. So I will be expecting the next draw on liquidity to be this previous daily low. Good. And you can see how price took out this previous daily low, but then it retraced back into the range. So the next drawn liquidity would be the previous daily high. All right, you can see our price took out the previous daily high, but retraced back into the range. It closed below the range. So the next drawn liquidity will be the previous daily low. Now you have to be aware that it doesn't work all the time. This is just something to give you the most likely draw on liquidity. All right, now you can see price actually was bullish. All right, because it took out the high, then we anticipate that next drawn liquidity will be the previous daily high. Good. And we have that price closed above the previous daily high. So the next drawn liquidity will be the previous daily high. Okay. Now we see how price ran, took out the previous daily high, but retrace back into the range. Seeing this, we put our next drawn liquidity to be the previous daily low. And we have it. You can see our price came back down into the previous daily low and as well closed below the previous daily low. Since it closed below the previous daily low, then the next drawn liquidity will be this previous daily low. You can see price came for the previous daily low and then closed below it. Since it closed below it, the next drawn liquidity will also be the previous daily low. And you see how price ran for this low and then retraced back into the range. Because it did this, the next drawn liquidity will be the previous daily high. The other drawn liquidity, which is also very important, are previous weekly highs and previous weekly lows. Whenever a new week starts, you want to identify the previous weekly high and the previous weekly low. This is where price is most likely to go. You could either run for the previous weekly high or the previous weekly low, like we can see here. So let's look at some examples. So here's the British pound USD, and each of these lines delineates each trading week. All right, so here's the previous weekly high, and here's the previous weekly low. So I'm going to play price, and I'm going to see how price run for either the previous weekly high or the previous weekly low. All right, we can see how price took out the previous weekly low here. At this point, we have a new previous weekly high and previous weekly low. So let's see how price takes either of this area of liquidity. Okay, you can see how price took out the previous weekly low. We now have a new previous weekly high and a new previous weekly low. So let's watch to see how price takes either of this area of liquidity. Now this week took neither of this area of liquidity, and it happens sometimes. So now we have a new previous weekly high and a new previous weekly low. So I'm going to play price. Good. The previous weekly low was taken. We then have a new previous weekly high and previous weekly low. And then the previous weekly low was taken. You will note that each time as price moved, it was taking the previous weekly low. So as the same concept as used on the previous daily high and previous daily low can as well be applied to the previous weekly high and previous weekly low. Price kept taking the previous weekly low, telling you that the next week is most likely to take the previous weekly low. The second concept you will need to understand are swing points. What's a swing point? A swing point is formed by the three candle pattern, right? You can see here, this candle 1, candle 2, and candle 3. A swing high is formed when the candle at the middle is higher than both candles at the left and the right, like you can see here. And then the swing low is formed when the candle at the middle is lower than both candles at the left and the right. So it's very simple to identify. Now, when we identify a swing high, we want to anticipate that the next candle that will be printed, which is the fourth candle and as well probably the fifth candle, will be a bearish candle. And as well, when we note a swing low, we want to anticipate that the fourth candle or the fifth candle will be a bullish candle. So let's look at an example quickly. So here's Euro Yen. One very important thing I want you to notice is swing point indicates turning point. All right. So you can look at here, we have the three candle pattern, the candle in the middle here. You see, as soon as it was formed here, price became bearish. As soon as it was formed here as well, you can see it being formed. Price was bullish. Formed here, price was bearish. Here again, bullish. Here again, bearish. So they form swing points. Okay. Now let's go deeper. If you look, we have the swing high here. All right. We have 1, 2, 3. The next candle was what? A bearish candle. If you look at this level here, we formed another swing point. This is 1, 2, 3. The next candle expanded higher, although we have a bearish candle, but there was an expansion higher. And then the next candle, which is the fifth candle, was bullish, sixth candle bullish, and the seventh candle was as well bullish. Let's look for another example. Okay, so now we can see a swing point being formed here. This is the third candle. This is 1, 2, 3. The next candle was what? Bullish. And then the fifth bullish, sixth was what? Bullish. Okay, here again, we have a swing point. We have the three candle pattern. All right, this candle is higher than both candles by the left and the right. So the fourth candle bearish, and then the fifth candle bearish. So usually, not all the time, when you find swing points, you want to expect the fourth candle or the fifth candle to go in that direction. All right, so we have a swing point here. So this is 1, 2, 3. The fourth candle was what? Bullish. Fifth candle bullish. And then as well, the sixth candle was what? Bullish. We have a swing point here again. So we can see this is 1, this is 2, this is 3. What happened? The fourth candle was bullish, fifth candle bullish, and kept going. So now we have a three candle pattern currently. So I'm expecting that tomorrow, which is a Tuesday, that's the 18th of November, Euro yen should be what? Bullish. Then now the last concept, which is liquidity delivery. Liquidity can be classified into external liquidity, ERL, and internal liquidity. These are the two kinds of liquidity we have based on liquidity delivery. All right. So external liquidity are buy-side liquidity found above range high or swing high, or sell-side liquidity found below swing lows or range lows. All right. Then internal liquidity are the fair value gaps we find inside the price range or the short-term highs and lows. So let's look at an example quickly. So here's the euro yen. All right. Now, from this range low to this range high, okay, what is found above this range high is called buy-side liquidity. And what is found below the swing low is called sell-side liquidity. They are both external range liquidity. Okay. So here's a price range. This move here is a price range. All right. This move here is a price range. A very simple way to define a price range. A price range is formed by two opposite swing points. We already went through what a swing point is. A swing point is formed by three candle pattern. We have 1, 2, 3 when the candle in the middle is higher than both candles by the left and right. And then the same for a swing low when the candle in the middle is lower than both candles by the left and right. So in between this swing point, we have what? A price range from here to here. This is the swing point from here to here. We have what? A range. Here's also the swing point to this point here. Although we have this, but we'll take this as a single range. All right. So here's a price range. Here's a price range. Here's a price range. Okay, here too is also a price range. Okay, now we all know what a price range is. So at the extreme, that is at both highs and lows, we have what? External range liquidity. Then within the range, that's inside the range, we have what? Internal range liquidity. So what are the internal range liquidity? They are both the fair value gaps and then the short-term lows and short-term highs. Now, we need to understand that price moves from external range liquidity to internal range liquidity and from internal range liquidity to external range liquidity. Okay, if you look at this level, you could see how price formed the range. Okay, price took out what? The buy-side liquidity and then went forward. The price inefficiency here. Here's a price gap. This is also an internal range liquidity. After taking the internal liquidity, price ran forward, and the external liquidity, which is the buy side liquidity. And after doing that, price went forward. The internal liquidity we can see here is the fair value gap, and then here also is a short-term low. After doing that, price now went forward. The external liquidity, which is the buy side liquidity. We can see the same thing happening here. Price went for the internal liquidity, which is the fair value gap here on Friday last week. And then later on took what? The buy side liquidity, which is an external liquidity here. Okay, so we see this happen over and over and over in price. If we go down to the 1 hour time frame, you would see this happen. You can see how price went for the internal liquidity here after taking the external liquidity. So from this point to this point is a range. So we have at the low, sell side liquidity. At the high, we have buy side liquidity. Okay, so you can see how price ran for the buy side liquidity and then retraced back into this what? Fair value gap for internal liquidity. So whenever you see an external liquidity taken, you want to anticipate that the next drawn liquidity will be an internal liquidity, which is what? The fair value gap or a short-term low or short-term high. After saying all these, let's look at an example and see how we can combine all these to get a trade setup. So here's the BTC, the weekly time frame. Now you can see a whole lot has happened here. Price took out the buy side liquidity and then broke structure. So here's a market shift. Price reversed at this point. And not only that, it actually closed below this up close candle, which indicates a change in state of delivery. So here is a weekly order block. And then we can see as soon as it broke structure. So this is the last leg that took liquidity. Okay. You want to start from the leg that took liquidity. If price should break below that leg, we have a market shift. And the reverse is the same for a bullish market. Let's say if price does something like this, it took liquidity below this low and then broke this high, we have a market shift. So this is the run that took liquidity. We want to go to where it started from. If price should break through that high, we have a market shift from what? Bearish to bullish. But we have the reverse here. Now, here was what happened. Price created a higher high, a higher low, a higher high, a higher low, a higher high, sweeping the buy side liquidity up above this high, and then broke through this low with this candle here. So we have a market shifted from bullish to bearish. So let me take this out so we can see it clearly. So from this is the swing around the buy side liquidity. You can see how price break through it. Okay. Then the second thing that happened was that price closed below this up close candle, which indicates a change in state of delivery. If you want to learn more about the change state of delivery, I'll leave a link to the video so you can go watch. As soon as price closed below this candle, it confirms what our bearish order block, and this candle here returned back immediately to this bearish weekly order block and found resistance to run lower. Okay, so now once we have this shift, what we want to do is we want to identify our next drawn liquidity, and then price moves from what? Liquidity above swing highs and below swing lows, and as well market inefficiencies. So a fair value gap is an example of what? Market inefficiency. So you can see as price shifted, after seeing this, which indicates bearish prices, we want to identify our drawn liquidity, of which is the sell side liquidity below the swing low, and then there's fair value gap. Another thing you could do is if you draw your feed, okay, from the range low to the range higher, this is our daily range, you will see that price shifted at premium and it's heading what? To discount. You want to sell at premium and buy at discount. So I'm going to take this candle out. All right. We're going to study that candle. If you look carefully, you would see that the previous weekly low was taken. And if the previous weekly low was taken with a close below the low, we're expecting that the next likely drawn liquidity would be the previous weekly low. So here will be our drawn liquidity. Remember, you want to identify both the previous weekly low and previous weekly high. But because we've seen all this price action with context, we're expecting price to run lower. Price just found resistance at this bearish order block. Okay, and price is still at a premium. We want to see price run toward a discount. So we're expecting the previous weekly low to be taken and as well the sell side liquidity. So let's go to a daily time frame. Okay, so here's the previous weekly low we outlined in the weekly time frame. Secondly, remember price moves from internal range liquidity to external range liquidity. So with this range, the internal range liquidity we have are this fair value gap and as well this fair value gap. So we expect either of this internal liquidity to be taken before price runs for what? External range liquidity. So because price took the previous daily high and closed above it, I will anticipate that the next drawn liquidity will be the previous daily high. All right, you can see how price took it and as well closed above it. So the next drawn liquidity will be the previous daily high and probably this area of inefficiency. Good, you can see how price took it. So now you could see that price retraced back into the range. The next likely drawn liquidity will be the previous weekly low. Good, and there we have it. So because price closed below the previous weekly low, we're anticipating that the next drawn liquidity will be the previous daily low, which is 1. Secondly, price has taken what? The internal range liquidity, as we can see here. We're anticipating that the next place price is most likely to go is the external range liquidity 2. And secondly, price has formed the 3 candle pattern. So we have 1, 2, 3. So we expect that the next candle to be formed will be a bearish candle. So we have 3 confluences in our favor. What we want to do here is we want to go down to the 1 hour time frame. Okay. So here's our previous daily low. And then here's our previous weekly low. And then here is our sell side liquidity in our higher time frame. All right. So I'm going to play till we get to the next day. Good. So we are going to identify our daily open. So here's our daily open. Want to be selling above daily open and buying below daily open. So because we want to sell this day, we want to sell above the market daily open. The price created a range. We have the range high and the range low. Now we're anticipating that price should take the internal liquidity. After doing that, run for the external liquidity. Remember, this is our previous daily low. And then you notice that we have relatively equal lows. Relatively equal lows and relatively equal highs are strong drawn liquidity. And it's stronger when the most recent formed low is higher than the previous low. So you can see this is a bit higher than this. Okay. So this is very, very strong. A very, very strong pool of price. Okay. So here is our fair value gap, which is our internal range liquidity. So we expect price to take internal liquidity. After doing that, they run for the external liquidity. So we're going to play price. I'm going to wait for London Q zone. So this is a London Q zone. What we're going to do is that when we get to London Q zone, we're going to go down to the 5-minute time frame. So here's our fair value gap, our 1 hour fair value gap, internal range liquidity. Now we have a change in state of delivery. This is a consecutive up close candle. This candle here confirmed the bearish order block, our 5-minute bearish order block, as soon as it closed below it. And you can see how price returned right back to it. So we're going to be selling from this point. And then I'll stop above this high while aiming for the previous daily low. Okay. So let's play price to see what happens. Beautiful. And there we have it. So how to use this, I gave you 3 concepts. The first is the next day model. The second is the 3 candle pattern. And the third is the external range liquidity. All you're looking out for is at least 2 should be in your favor. You don't have to see the 3. You just want to see 2. If 2 points towards a particular direction, you want to go with that bias. All right. I hope this was helpful. Please, if you enjoyed this video, give it a thumbs up and do subscribe to get more videos from me. All right. See you guys next week.